Hi everyone, welcome to another episode of Phillip Futures Trading Podcast. My name is Liao and today we have David Ng with us. He's a full-time trader with IcebergX and today he will be giving us a quick review on his upcoming webinar with Phillip Futures on the 8th of September, which is on this coming Wednesday. So please not miss this insightful webinar with us, where David will be discussing the opportunities and benefits of trading CME Micro E-Mini products in the futures market. How are you doing, David?
Yeah, hi, I'm doing great. How are you doing?
I'm doing good, thank you. Good to hear that. So now I will pass on to you to talk about our upcoming webinar.
Yeah, sure. Thanks, Leo. Okay, so I just before I start, a slight preview of what I'm gonna be sharing next week. So I think the main discussion will be definitely on some of the opportunities especially in the CME micro indices market. If you are trading on the micro E-Mini Dow or even a micro E-Mini S&P, indeed those markets has actually offered you some quite good opportunities when it comes to trading those markets. So I'm just going to have a very slight preview of what I'm going to be sharing on that day. And obviously with any public presentation, I usually disclaim myself that any presentation here is purely based on educational purpose. So any recommendation is purely based on personal opinion. So do consult with Phillip Futures representative for the next course of action. So I'm just going to start off with just highlighting on where the market is right now. If you look at some of the major US indices, indeed you can clearly see that those markets are actually hitting an all-time high, especially on the Nasdaq market. And if you just compare to last year, where we just started on the onset of the COVID-19 pandemic, we saw that some of the world major indices, including the US major indices, has actually slumped to record lows. But since then, thereafter, once we got the vaccine in place and market starts to reopen, major economy starts to reopen, we start to see growth start coming back into the picture. So if you just look at this chart, you can clearly see that world trade last year, for the first time, I think over decades, we hit I think it was in a negative territory. And just 2021 and the beginning of this year, we start to see recovery as a lot of major economies starts to reopen their economy. So trades are improving, they are showing sign of growth. If you just look at the Baltic Dry Index, which measures your shipping costs around the world, that index has actually also hit relatively high for the decade. So it goes to show that the world trade is actually improving, and that translates into higher shipping costs as well at the end of the day. So with these two in place, it shows that the global economy is indeed on the strong footing of recovery, and therefore it's actually translating to higher prices when it comes to higher confidence in the market. So that explains why across some of the major US indices, we are seeing a bit of strength in that regards. Now, obviously with COVID-19, a lot of central banks around the world has actually realigned their movement, especially when it comes to interest rates as well as pumping liquidity into the market. So one of the fact is that you just look at US Federal Reserve itself. The central bank itself has do a lot of monetary easing in terms of pumping liquidity in the system every single month, with the tunes of 120 billion into the market. So just look at the Fed balance sheet, we have actually seen an exponential growth at the start of the COVID-19 pandemic. So I think just over a span of 18 months, Fed balance sheet has actually increased almost twofold, and that shows the significance of the monetary easing that they are doing in the US. And with that regards, also we can clearly see that some of the major indices are also getting part of it. And if you just look at some of the monetary supplies, if you look at M1, that also showing you sign of growth. So indeed that the US Federal Reserve has pumped so much liquidity, and that will translate into going into certain asset classes. And one of major beneficiaries is obviously the indices market. Now, obviously with so much monetary easing that's being done by the central banks across the world, not only in US but across in Europe, as well as other major central banks around the world, as a result of fighting the COVID-19 pandemic, we can clearly see that as a byproduct, inflation starts to rise. So if you just look at some of the US numbers, core inflation numbers, those numbers are starting to tick higher, especially in the early part of this year. When economy starts to reopen, when we start to see traction in economy, a lot of this activity starts to gain momentum. And when demand starts to pick up, but supplies are not sufficiently to cover those additional demand, we start to see rising prices, and that's a core concern. Obviously, there's talks in town where inflation could be a concern going forward. Especially with in the upcoming FOMC meeting, there's slightly signs that Federal Reserve might start to taper, and eventually next year we start to see higher interest rates. Now, this as a result of fighting inflation. Inflation is going to be a concern in a medium to longer term basis. If you just look at some of the agriculture prices, we start to see some of the key asset classes in commodities. Those asset classes are reaching at multi-years or even decades high. So all these are feeding into higher inflation level. And eventually, I think Federal Reserve have no choice, but they have to respond with hiking interest rates levels. And obviously, I think inflation is something for us to watch out, which I'm going to share a little bit on this aspect in the webinar later. But I think it's crucially, if you are trading the market, you are observing the market, inflation is certainly a variable that you have to watch out, especially going into the medium to longer term aspect. Now, despite all this, despite what the Federal Reserve is doing, and despite what the central banks are doing, if you just look at the stock market itself, it's showing you a lot of it shows you a lot of sense of optimism in the air. But you just look at some of the week's index, which we call it the fear gauge market index, which literally tells you how the market is fearful for any spikes in volatility. Right now, the market don't see any spikes in volatility, and in fact, the market is actually very complacent at the moment. But obviously, when sign of calmness in the market, usually it always precedes very sharp movements in the market. So I'm just going to share a little bit on this as well in the webinar. As seasonality is an important play whenever you trade, whether it's indices or commodities, seasonality will have an impact. So as we enter into the third quarter of the year, usually where third quarter, if you look at some of the major US indices, usually this period we call it a volatile period. So do watch out and pay close attention to weeks because it does measure how volatile the market is going to go in. Now, obviously, the current reading is still, compared to last year, it's still record low, relatively way lower than what we are seeing in early parts of 2020. But nevertheless, if you just look at week's futures, if you just look at the term structure, it's showing you signs that there's some premium in the longer dated months, which shows that as we go into the third and fourth quarter, we probably could see higher volatility in the market. And as a trader, we should watch out on a week's index, because that's the first sign that will tell you whether the market is going to go into a very volatile period. So obviously, as a trader, you are trading a market, you love volatility, and it is definitely something to watch out for as well. Now, one aspect and one narrative which I want to bring up whenever we talk about the US indices is to look into the margin debt financing. What I refer here, margin debt financing, is actually to refer to you some of the debts that's incurred to finance stock purchases. So obviously, look at the chart on the right, you can clearly see the black line is indicate the XPS, the S&P 500 price movement. And if you just look at the green line, which is the margin debt level for some of the major retailers. Now you can see that with rising margin debt, you can clearly see there's a rising market. For the simple fact that as retailers feel there's more confident in the economy, they are willing to take on debt to finance their stock purchases, because they are looking into higher returns, and hopefully the higher returns could translate into gains in the market. So obviously with that, there's leverage involved. So retailers generally are still optimistic with the market. They still can see gains in the market. So therefore, they're willing to pile into margin debts. Now, this thing can start to be a bit more worrying in a sense that when margin debt starts to decline, which means that a lot of these retailers starts to see the market is a bit more peakish. Now, normally when margin debt starts to peak, normally when market starts to peak. So when margin debt starts to decrease, that means retailers are starting to be a bit more cautious, and they start to reduce down their debt. Now, I will share a little bit more in detail why we should pay more attention to margin debt in the webinar itself. But I just want to give you a sense that margin debt is something a variable that we have to watch out for. So based on the latest numbers that we see from some of the key reports, it shows that the margin debt starts to decrease slightly. And as we go forward into further months, into further weeks ahead, it's crucial for us to watch whether that margin debt will start to decrease further. If that's the case, then we're likely to see probably a possible peak in the equity indices, especially in the US market. Now, if we just look at indices alone, the US indices, obviously 2021 has been a very good year for most of the companies listed in the US, whether it's S&P 500 or even the Dow Jones 30. That this in fact shows that whatever we see in the price valuation, it does justify by the stronger earnings. But the thing to take note is that not all sectors are actually benefiting in a similar fashion. There's certain sectors that actually benefit more than other sectors. But you can clearly see the fund flows are starting to shift. So last year we saw that the bellwether sectors in the economy was definitely the technology sectors, the consumer discretionary. Now this year is slightly different. We start to see industrial, financial, and even energy coming into play. So definitely you can see some of the shift of sectors going to different types of sectors this year. And by seeing the flow that's coming out from certain sectors, it does point you that generally the sentiment has also shifted in the market. So I think that's again another development that's interesting to watch if you're trading on some of these major US indices. So it's definitely you have to pay a close attention to, especially when it comes to fund flow. Which are the sectors that will the fund be focusing next? Now, on the technical aspect, as I mentioned earlier, the previous few slides, is try to highlight that, in fact, we might be going to a volatile season in the US indices, and in certain aspect that the strength of the current uptrend across the major US indices are showing you sign that is starting to get a bit sluggish. They're starting to see tiredness in the strength itself. Now, in technical aspect, one of the key indicators for us to measure a trend strength is to look into ADX. So if you just look at the ADX indicator, we saw rising ADX value early part of April this year, and therefore it translates into higher S&P 500 prices. You saw that massive uptrend rally is still sustainable, but off late, if you just look at ADX value, it starts to decline. That shows that the trend itself, the strength of the trend, might show a bit of weakness. So I'm just, in this webinar, I'm also just going to uncover some of the indicators that you can use whenever you are trading the S&P 500 Micro E-Mini market. Not only it applies on the S&P 500, you can even apply on Micro E-Mini down as well, or even NASDAQ to some extent. So as a trader, it's important for you to have certain tools that's available to you for you to time your entry and exit accordingly. And obviously, with every trading plan, you also must incorporate risk management, which is a very important tool. And last but not least, I'm also going to share with you in that webinar is for you to start trading, why the Micro E-Mini is definitely the perfect contract for you to start off with. And I'm just going to share with you some of the key benefits of trading these products. So I think in all, I think that's going to be some of the key highlights that I'm going to share in the upcoming webinar. And if you are trading in the US markets, definitely it's going to be exciting times going forward. There's certain variables that you need to be careful of. And if you are a technical trader, there's certain tools that you can use for you to really start to gain some opportunities in the market as we head into volatile period, especially when it comes to the US markets. And last but not least, probably I'm just going to end off in that webinar series is probably going to share with you some of the skills that you need, probably need to become a trader, especially when you trade the US indices market. So these are some key points which I'm going to touch on in the upcoming webinar. So I'm just going to hand it over to you, Liao.
Okay, thank you very much, David, for the fantastic preview. Now, once again, for our audience out there, if you haven't registered for this upcoming webinar, you can find the registration link in our official website, or you can also drop us a message on Facebook, and our representatives will be more than happy to assist you. Last but not least, you can also follow us on our social media on Facebook, Instagram, YouTube for any new updates from us. Now, we have come to an end of our podcast. So once again, thank you, David, for being here today. I will see you in the webinar on Wednesday.
Yep, thank you. See you then.